Okay, so this is how the SPY is traded in an hourly time frame. So you could just go with true signals. So you get a true signal right there, you short. You short right there, you put your stop above the last area, which would be there, and just to show that that wasn't exceeded on the signal, so that level was not exceeded right in the signal there. So you short, and if you're trading options, you could do swing options, ones that expire out in the future a couple days or at least one day. So you have this short. See if we could get the date on that. Parameters, there's the date, 12/16. The time is going to be different on this. The hours are way off because it's not a US broker. So you're looking at 12/16, okay, and you're still in it. Let's see, you do a swing. It looks like it gapped down, so you're still in there. So if it gaps down, I'm going to say that this is probably the next day. Yeah, so that was a weekend move. It says 12/29. Okay, so you're in a swing trade, and now you got money on the open. And sometimes when it gaps down, it's a good idea to take your profit and run if that's what you did. Now, if you're still in this trade, then you see this signal right here. That's a new signal right there within this. It supports the structure. If that's like a gap down, you could short again and do the same play. Because now you're under resistance as well. Okay, it looks like that is a strong resistance zone. Okay, so you have the resistance set up. Look at this resistance. There's no probe higher even to test that, so it's strong resistance. There's no probe, there's no tail of a candle tipping above it and testing into it or above it. There's no candle going into it. And now you have this fresh signal, so you do the same thing, and you have, let's say you short, and you have the date of 12/30. Looks like it came out to about the same time as the last trade. There was another hourly signal to short. So we got a pattern going on. Okay, so this is probably the next day. Yeah, it says 1, 2. Okay, so you have 1230 short, 1700, and then you see it gap down again. This time you have strong resistance, and the pattern is stronger. So it was, especially in hindsight, right? Especially in hindsight. But look, you have a building pattern. You have another indicator. You have that and that. All this is a reason to hold longer. And then you have a cut right there. That's your exit point. That's also a potential opposite signal to go long. Okay? So then you have right here, you have to look at all the patterns. You have a decision doji right there, and then right now you're seeing the stairs. You're seeing the stairs decline. So now on this one, you see a pattern building right there. That's probably your go long, which in hindsight it obviously is. You have a bear candle that opens into the body, and you have stairs cutting. So you have to take all things considered. Then, if you did go long, now you have a swing long, right? And then it boom, hits higher. It opens up above resistance and support. You have a reversal. You have support okay, and it stays above it. It stays above it. You have just a long string of positive bars. You have some cuts in there, but you still have, this is why you got to watch the support. You still have candles not going below any support here. And except here you have one touching, but it never probes. It never sends a probe below the support. It just keeps building until up here. Then you have it actually start to break down here with this candle open right there, open bearish. So let's see what happens there. So right there you have a sell signal there, but only 1 hour of downtime. You have a step pattern cut right there, which is an indication to get out. So you have a longer term pattern right here that forms, but you have a definite retracement that's like a Fibonacci retracement. So if you have Fibonacci tools, those Fibonacci tools come in handy in these longer patterns. So you have a Fibonacci thing going on here, plus you have a step right there, and then you have this going on. It looks like it wants to go lower, but then you have right there, you have a doji right there. You have a doji, you have to pay attention to all these things. And then after the doji, you have a cut, not cut, but you have a open just above the doji. Okay, that is everything supporting long. And right here, say had you gone long on that, use combination of the tower signals, the candle patterns, the trend with the supports and resistance. If you had a swing trade, there's a gap up and you go long there, you can go long there, okay, because you lost this pattern over here. This pattern got lost, okay, it got weaker, and now you have this red, okay, you have red right there combined with the doji, and then the open confirmation, opening above the doji, confirmation, or at the body of the doji, and then building. But it is definitely just above it, giving it a bullish signal, bullish confirmed, okay. You go long with the swing on an options trade, then next day you get confirmation right there, confirmation of the long signal, and then it cuts right there, step pattern cut, okay, but it still continues, okay. Then you have the candle that breaks it right there. So this candle right here, okay, had a little probe, and then this one had an equal body and a probe, and then it became bearish. So it's a tough play. It ends up going up higher, support ends up holding, and it goes up just a little higher, and then you get a sell, okay. So when you do your swing, you can do your swing options trades. It starts to build below the resistance, tries to get it back above it, but resistance, support fails, resistance forms, and that's it. Support becomes resistance, boom. Then you have a tower cut after a long tower and cut. That's it. That's a reversal signal in itself right there. Then you have another doji pattern right there, and you have the open. You have patterns going on that are consistent and playable. Okay, so you have the doji indication to go long, especially on that open. Then right here, after your long, then you have that. That means you hold your long for longer. Okay, that means you hold your long for longer. If you have an options contract with time on it, and then you have the gap up. When you see those gap ups, you have to strongly consider, is it time to get out? Okay, it opened right there. It probably is, but it does go a little higher. If you're on an options contract, it could end up being a lot more money. But then again, you have a very short time window, okay, on patterns like this. Then you have the short. This one, you short, and it's big money because you have that huge gap down. Then everything pans out. And then over here, you have a long. You go long. Signal of death means that signal right there was no good. Okay, you have